Hey everyone, this is Hunter Satterfield, one of the partners here at Kane Waters and Associates, as well as the Chief Investment Officer and a member of our investment committee. As always, I am joined by my fellow partner, Brian Bortz, who is the head of our investment committee, as well as Brad Sanders, the Managing Director of Tectonic Advisors. We are here to bring you the April monthly report. For the month of April, the S&P 500 was up 1.6%. Global stocks up 1.3%, domestic bonds up 0.6%, and then finally global bonds up 0.4%. And Brad, I'm going to come to you first, as always. Really an interesting thing as we look at the S&P 500 for the year. The S&P is up right around 9% through the end of April for the year. However, the equal weighted S&P, which gives equal weighting to each individual holding in there, is only up 3%. So there's a quite sizable gap between what the index is showing and the equal weighted. You want to talk a little bit about what is creating that gap and what that signals for sort of the broader market outlook?
Sure. As we've alluded to, and as we've seen in years prior, you have a disproportionate weighting in the index to a handful of companies, most notably mega cap technology. So in the S&P 500, Microsoft and Apple by themselves make up over 14% of the weighting of the S&P now. If you look at a broader index like the Russell 1000, they make up 25% of it. So in the Russell 1000, you're supposed to own 1,000 companies. You have a quarter of your money in two because they're market cap weighted, and the cap weights have gotten so big. If you look at that, what you just mentioned, the market cap, the normal S&P 500 is up 9%. Microsoft and Apple make up over 4% of that return by themselves. So almost half the return comes from those two companies. If you add in NVIDIA, Amazon, and Google, you get up over 7%. So another way to look at it would be 495 of the 500 S&P 500 companies are only up about 1.5% year to date. A good analogy to think of this, I've mentioned on this call several times about how I expect the market to bifurcate like it did in 2000 and 2001, where you have the indexes not doing terribly well because they're all weighted to a very expensive companies that probably have the path of least resistance being lower valuation wise. But you have a big segment. You had a big segment of the market back then that was cheap already. And while the Nasdaq was losing 70% in 2000, a good portfolio of blue chip value stocks was up over 20%. The market's very much like that now. You have the mega cap technology companies that are way up here, but through all of last year and prior to that, when you get into small caps, you look at the Russell 3000, their valuations are already lower down here. So what you're going to have is, like, if you think of this as the surface, if that gives way, all the stuff up here is going to come down, but there's not a lot of room for the stuff down below to fall. So that's where we're concentrating on what we want to own, is the stuff that's already repriced lower, because that capital is going to have someplace to go. And just to give a quick example of sort of how frothy and silly a little bit of this has gone. Microsoft had earnings last Wednesday. The revenues grew 7.5%. Earnings were in line with street estimates. They didn't blow anything out. And the stock went on to add 200 billion in market cap in 2 days. Okay. It was already trading at a 30 forward PE multiple before that earnings call. And then it grew 200 billion more after that. I'm not like the brightest crayon on the box, and I'm not perfect at valuing equities, but I do have a CFA charter, and I do have a degree in finance. And I know that when you have a risk-free rate in the fours, it takes a way more than 7.5% revenue growth into perpetuity to maintain a 30 multiple, just to maintain that 30 multiple, much less grow it. So you can kind of start the clock on that. At some point, those kind of companies are going to sink due to their own valuations. It doesn't have anything to do with operations at this point. The weight of their own valuations are going to drag them lower, because you're not going to have three companies comprising the equivalent of 40% of GDP annually. That's just not how the economy works. And so you're starting to see just this one narrow segment of the market drag the index along. We're not concentrated there. We think you could see those revalue much lower, and then things are going to start to make a lot more sense, because there's areas of the market that are being ignored right now that are cheap enough to own. even if we're going into a mild recession, even if we're going into an uncertain period, there's places to put your money right now. It's just not what's dragging the market higher, so nobody's looking at it. If you own that stuff when everybody turns their attention to it, you get the benefit of that tailwind of all that capital rushing into it. And so that's where we're spending a lot of our time right now.
Yeah, that's great. Thank you. And Brian, coming over to you, we've got a Fed decision here coming shortly, another one. We expect, obviously, a rate increase. We had a market today that was frustrated and was in the red largely. And we kind of continue to see this year sort of this seesaw back and forth, back and forth. And obviously, it's been, like we've been talking about in here for a long time, a bumpy road higher. You want to talk a little bit about what this, sort of outlook means for our clients?
Yeah, thanks, Hunter. It's exactly what you said. I mean, this is the April report, so this is our fourth report this year, and every report this year has been really strong month, really volatile month, really strong month, really volatile month, really strong month. So it's back and forth, and it's exactly what we had talked about pretty much for the last year and a half, that we were going to have volatility and to not get too far ahead of ourselves. What I see here for the rest of the year really is just letting this cycle play out. We are a lot closer to the end of this cycle, I think, than we are the beginning of it, but we still have some volatility ahead of us, and we're still letting our clients know that. The market doesn't know what to think right now. It's scared of its own shadow to some extent. Last week, you had labor numbers that were, everybody was griping that the labor market was too tight and the market negatively react. And then today you have labor numbers that the market's softening and everybody's negatively reacting. So no news is good news here. I think the banking crisis, there have been a little bit of stability put back into the banking industry when UBS steps up and decides it's going to purchase the assets for First Republic. I do think that there's some stability happening there, but people are nervous. And when people are nervous, the market's nervous. And so our advice to our clients, and what I've been telling our clients, is to just relax. We have a long-term focus. We're going to let this cycle play out. And we really are, in our opinion, where our portfolios are ahead of the game this year so far. So pretty happy with how things look through the first 4 months.
All right, well, great. Yeah, thank you guys. Again, we'll have another Fed decision here shortly, and we will be able to talk about that in our May report. We hope that the end of the spring semester for all of you is wonderful, and we will see you at the end of May as we kick off the summer. Thanks so much.